believe we've waited long enough. You snooze, you lose. I feel like I need to do a countdown to this webinar just because of the interest rate and in hearing what's going on out in the audit world. Obviously, this is a big topic. It's nothing new in the sense that the tax office audits have been happening for quite a while. They seem to go up in frequency in certain years and down in others, but it's just something that's out there. It's a concern for every tax business owner, and it's something we just wanted to review and have some insight into from somebody that's in the know. So a good friend of the company is Mr. Garret Gregory. If I read his resume, it would take the majority of the webinar, so I'll spare everybody that. And Garret, are you on the line?
I am. Can you hear me okay?
We can hear you loud and clear. Thank you. Thank you very much for being on the call and sharing with us your knowledge. If you wouldn't mind just without me reading, just give me the Reader's Digest version of your background, because I think that's really unique. I mean, you used to be on the dark side. You've since come to the light and are now helping out. I mean, actually, just because I know individuals that are on the call, I see familiar names that people that you've represented and previously. So it's pretty interesting. If you could just give us a quick overview of you and your wife's background. I know you run the firm together.
Correct.
Cool.
Sure. Sure. Well, yeah, my wife and I, upon graduating law school, actually, with a brief interlude to PricewaterhouseCoopers in Silicon Valley, started right up with the IRS itself. So I worked in the national office in Washington, D.C. My wife worked in the field office in D.C. Then we both transferred to the field office in Dallas, Texas. So we were attorneys for the IRS for about 12 and a half years each, so about 25 years combined, and got to see obviously a lot of interesting things on the inside. But then about 6 years ago, decided we wanted to jump out and actually start helping people rather than just collecting money for the government. And so we started our own law practice, which is Gregory Law Group, which is based in Texas but has offices out, and we represent clients in, at last count, 24 states and 8 foreign countries. But a big chunk of that, unfortunately, and a growing chunk, is tax return preparers for reasons that we will talk about more as we go through this webinar.
Well, awesome. I mean, we want to boo you and give you a high five at the same time, but we'll give you that. We'll go with the high five for now. Yes. So there won't be a PowerPoint presentation. This is really going to be kind of a dialogue, and I anticipate a lot of questions coming in. So just kind of a quick preface. There is the ability for you in the control panel of the webinar. There's a questions section. If you have a question related to the topic that Garret is discussing at that point, I will wait until there's some sort of natural break and then politely interrupt him to pose that question. If it's unrelated, we're going to be covering a lot of stuff, so I'll probably hold off. And then if it doesn't surface in something discussed from that point, I'll then bring it up towards the end and more or less a kind of a Q&A. To answer the question that just popped up, is this recorded? Yes, it is, and we will then be distributing it upon its conclusion. So with that being said, Garret, you just want to kind of just dive into it? I mean, I know you can talk about this stuff for hours and hours and kind of drowned us in code sections and whatnot, but kind of just keep it a little high level initially, and then as you need to dive deeper into the subjects. So,
Sure.
But as far as tax office audits, yeah, tell us what you know.
Sure. Well, I'll start with the bad news, and it'll probably continue on front for a little while. But basically, when I first started seeing these cases, 6+ years ago, they were very isolated, kind of sparse, and very focused on just one thing. That's the single refundable credit of the earned income tax credit. As we stand here today, the due diligence rules and penalties now apply to 3 refundable credits, plus, as we're all about to head into this next tax season, the penalty structure will also apply to a fourth item, which is not a refundable credit at all, but head of household status, just actual designation of a filing status. And I've seen personally, just through my firm, but I've also read reports from the IRS, so it's not just me, the incidences or the numbers of audits are dramatically increasing, and much of that at the behest of the United States Treasury Department and their the Treasury Inspector General for Tax Administration, which is kind of the watchdog, has recently made a very strong recommendation that the IRS, they think they are under auditing to the tune of about 3,000 to 5,000 tax return preparers per year. So all of this sort of comes together to form a perfect cocktail of it's going to get a lot more intrusive on the side of the IRS coming in and wanting to examine tax return preparers, specifically those return preparers that produce a pretty good volume of returns that contain refundable credits. And of course, we're talking about earned income tax credit, the education credit, or the AOTC, or the CTC, ACTC, the child tax credit, additional child tax credit, and now, of course, the head of household designation. So, whereas I've been saying for years, and I keep hoping I can stop saying it, but I really can't, and I'm actually having to say it with even more vigor going forward. But you guys, as tax return preparers, are by far the number one target as a group of the IRS. I mean, it's just not even close. When I look at our demographics in my firm of my clients, yeah, I've got a lot of doctors, I've got a lot of lawyers, I've got a lot of real estate and self-employed business professionals, but tax return preparers are my single, by far, biggest group of clients, and that's not just because of, they find me, it's because you're who's getting rung up by the IRS. So, and unfortunately, with reading the tea leaves and them continually expanding what the due diligence rules cover, that it's only going to get bigger. It's only showing the IRS is looking to broaden their scope in this area. So, unfortunately, I don't have good news on that front, but
you literally just described every single one of our customers.
Yeah, there you go.
Wonderful. Thank you.
Right.
Continue.
You're welcome for that. But anyway, yeah. So what do we do to stop that? What do we do to okay, the storm is coming. What do we do? Well, basically, all of you guys, and certainly the ones that run their own offices, this is more incumbent on you. But still true for the individual preparer as well, because it doesn't really matter if you're owner or you're just a return preparer that works in someone else's shop. If you get hit with a $40,000, $50,000, $60,000 penalty, it's bad no matter how you look at it. So part of how we handle these cases, and my typical engagement, and I know I've got a lot of clients probably on this webinar right now, so you can all nod your head in agreement. But most people approach me when they receive the audit letter from the IRS, or maybe they've gone through the initial phase of the audit and then they get that fun letter from the IRS saying, congratulations, we're hitting you with X dollars of penalty for your due diligence failures in these particular cases. And that, that's when I'm engaged. And how we handle it is probably different. First of all, there's not a whole lot of professionals, attorneys and whatnot, that represent return preparers in these types of cases. But I like to think we're a little different because we kind of view these cases as 1A and 1B. And what I mean by that is, well, of course, you, the preparer, are focused on, oh my gosh, make this penalty go away, or hopefully we can avoid the penalty. You're worried about that. That's what's front and center in your world. I, of course, understand that's the big number one, but a very close second is educating my clients. And I don't mean that in a condescending way. It's not that you guys don't know what you're doing, but I've just seen this so much more from the IRS's perspective and know what the IRS is looking for with respect to meeting your obligations with respect to due diligence, that I probably have a lot of knowledge and experience to impart on my clients as return preparers. And that's really, honestly, I'm probably at least as, if not more passionate about helping my clients understand, what's happening to them, why it's happening, and what we can do to kind of bulletproof them going forward, to make their shops better, to make their files look better. So if the IRS comes out in the future, which they probably will, then hey, that's okay. I mean, bummer, but at least we have a lot more confidence in how we're running our operation, how we're maintaining and managing our files. So come on in, boys, take a look at my files, and we're going to be in a much better position, than we were. And that's really my goal when I'm representing any of you guys, is to leave you better than I found you, to the extent that I have some knowledge to impart. And I really try to review your files very closely and give you pretty detailed analysis on that, so that we make you better going forward. But that's kind of how we approach these cases. And again, I know a lot of you on this call have, unfortunately, required my representation, so you already know what I'm describing.
Gotcha. So what is the audit process? I mean, first of all, I think it would be interesting to explore the topic of, what are the flags? Is it a percentage thing of your returns represent this? You have this many returns that have this many types of refundable credits or refund dollar amount, or you do this many returns within your office. I've got a friend that they do 5,000 returns within their office, a single location, 16 preparers, and he darn near gets a audit visit every year. I think it has a lot to do with, obviously, you have a monster tax office. How are you doing this when everybody else looks like the following? So what do you think are the big kickers that gets you put under the microscope?
Right. Well, you touched on them. I mean, it's a numbers game. The IRS is going to send their limited resources where they think they're going to, more successfully, mine a target that needs to be mined. So what I see very frequently is a return prep office that's doing at the very minimum 50% of their returns contain refundable credits. And even in those circumstances, a lot of times I'll engage with clients that they'll say, 50, maybe 50 or 60% of my returns contain refundable credits. Well, if we go through and look, that number, it starts climbing. It ends up being 70 or 80%. But certainly if we see that, and we see my sweet spot tends to be anywhere 150, 200 and up. If we're seeing that level of refundable credit returns coming out, that's going to get the IRS's attention. And then there's, not only is it just refundable credit returns, but they're also looking for certain criteria on those returns. What we call, I'll sort of put them under two main categories. The first category would be under QCs, qualifying children. Is there some weirdness going on there, for lack of a better term? And what I mean when I say that is, do we have a lot of single parents? Do we have a lot of single parents with different last names between dependent and the parent claiming the dependent? Do we have a lot of not even parents, biological parents? We have siblings taking care of siblings, grandma taking care of grandkids, concerned neighbor taking care of neighbor kids, stuff like that on the qualified children side. The higher percentage of your returns that contain refundable credits with those scenarios, those are going to get you tagged. Even little silly stuff. I was looking through a bunch of returns today, or return files today for a client. Simple things like W-2s not matching. So the report the W-2 income, but it didn't match. It was off by a couple $100. Nothing big, but it's another thing that shows the IRS, there's some shoddy work going on out of this tax office. We need to go visit it. And then you have things on the Schedule C side of the fence. Those are the two biggest areas: qualifying children, what's going to get you in trouble or get you tagged for audit, or Schedule C. And what I call the classic zeroed out Schedule C, meaning you either have somebody with too much ordinary income, too much W-2 income, So we have a Schedule C with zero or maybe a couple $100 of gross receipts, and then $15,000 or $25,000 of expenses to generate these huge losses that bring down their income, coincidentally right in the sweet spot for the earned income tax credit. Or you could have vice versa. You could have somebody that doesn't make any income or doesn't make enough income to claim the earned income tax credit or the other refundable credits. So we use the Schedule C to beef them up. We have zero expenses and we made $12,000. Well, gee, it'd be great if business actually worked that way, but we all know you can't operate a business without expenses. It just doesn't really happen. I mean, there's some few outliers to that, but by and large, any zeroed out situation where you have all income, no expenses, or the opposite, those are going to get not only the attention of IRS civil exam, but those will start getting the attention of IRS criminal investigations as well, especially as the IRS reaches out to your customers and they say, hey, what about this business you claimed that, had no income and all these expenses? And of course, what's your customer going to say? They're going to say, what are you talking about? I didn't tell my preparer about any Schedule C business, so I don't even know what a Schedule C is. So it must be my return preparer. Well, after the IRS hears that about 5 or 10 times from your client base, that's when they're going to turn the focus onto you and not the individual customers. And that's when it can start getting really scary, because it often will evolve into a criminal investigation at that point. And that's certainly what we don't want. But that's kind of what you're looking at.
So two little, I guess I'm going to chime in here for a second. I had heard at the IRS tax forums, the nationwide IRS tax forums, that the IRS this year basically, touted from the podium, Schedule Cs are going to be looked at way more closely, or a way wider scope, or so I don't know what they're doing on the back end to look at those and throw flags, or what it's going to do to funding if it looks weird and you have some of these other sort of characteristics like non-standard dependents, mismatched last names. You didn't file this dependent last year. Where'd they come from? Sort of scenario. And then the other thing that you touched on, Garrett, was W-2 mismatches. And I don't know this to be fact, so I'll call it a half fact, which is a term we use here inside the office when somebody doesn't have all the information. So just prefacing with a half fact that the Social Security Administration and the IRS are going to be doing W-2 matching real time, from what I'm told. So like on a daily basis, whereas before they used to receive kind of a batch file from the Social Security Administration well after the return had been funded, and then they would match, and then that's when it would trigger audits. I mean, after the return had been funded, they wouldn't receive it until sometime in March. They wouldn't receive the big file that said, all right, go ahead, IRS, now look at it. So they're going to receive a provisional file that allows them to match in a real-time basis that I think will definitely impact funding, which leads me to I think people are going to be tempted this year to file on check stubs, especially with the pre-acknowledgement loan product that the banks have rolled out, and I would highly caution them, but it's going to be interesting. So that's my tidbit. So
no, and I agree 100%.
So as far as the progression of an auditor, what to expect when you receive the letter and they come into your office, and how does that go down? Are they going to tell you exactly what they're looking for? Hey, you've got these weird things, so you can prepare beforehand, or is it kind of a setup or an ambush to a degree to where you don't know necessarily what's going on until they get there?
Right. Yeah, they're not going to warn you a whole lot. They're just going to say you've been picked up on a due diligence audit, so we've got to come out and review you and your office practices and more importantly, your files to see if you've met the requirements of Internal Revenue Code Section 6695G, which is the due diligence obligations of a return preparer with respect to these refundable credits, and now this next season, the head of household filing status. They're not going to tell you much more than that, other than, they either call you, send you a letter, or both, saying, I'm proposing this time. I want to come out to your place of business about 9 o'clock and sit down, and we're going to do an interview. It takes about anywhere from 45 minutes to an hour and a half, after which time I'm going to hand you a list of 25 files. You will go get those for me, bring them back. I will sit there for a day or two looking at those 25 files. If when they're done with those 25 files, they have found 4 or fewer due diligence violations, the audit's over. They will give you a statement of no change, meaning no penalty applies, and they will shake your hand and leave the office. And I've seen that happen exactly 0 times. Assuming they find 5 or greater violations of the due diligence rules, then they will request an additional 25 files, sit in your office for another day or two, review those 25, and then finish. And more likely than not, they just kind of leave and disappear on us for anywhere from 2 to 4 or 5 weeks. And then they issue us a report. Okay, and that report is going to contain a narrative, just a 1 or 2 page, here's in general what we see you doing wrong, and we're hitting you with, say, 60 incidences of due diligence violations at what was last year's numbers, $510 per violation. This coming up year, it's going to be $520 per violation. I won't try to do the math because I always screw it up, but ends up being a pretty good chunk. And you may say, well, wait a minute, they only looked at 50 files, how can it be 60 violations? Remember, each file has, leading up to this year, up to 3 violations per file with the AOTC, CTC, and EITC. And then this coming season, tax season, there's 4 potential violations. So each file could be worth up to $2,080 of penalties. So pretty staggering numbers. Some new things. So if we kind of take a step back, okay, so what is this interview you mentioned? What does that look like? Well, I've been through probably literally 120, 150 of these things, and they pretty much all look the same. With each year again, they add or tweak or change things. With this year, what I found, a couple of things that will probably interest this crowd in particular who's listening to me right now. First thing, hopefully this doesn't affect you at all, but they are really paying more attention to, especially if you're a tax prep office owner, how are your personal taxes? Are you compliant? Have you filed all your 1040s? If you owe any money to the IRS, are you in a resolution strategy with them? They're really focusing on that. And what I mean by that is normally when they come out, I've had examiners go out of their way to say, hey, look, tell my client, don't worry about this. All I'm focusing on is due diligence. I don't care what else is going on. I've got blinders on. I'm just looking at due diligence. Well, now I've heard this 3 or 4 times this tax season. I do have the ability to open up a personal examination on you personally. So not just this due diligence piece, but if I know that you are not in compliance, I'm going to initiate an examination on your personal tax returns. Okay, so that's sort of item number 1. So to all of you out there, if you have some unfiled returns, if you haven't been, keeping up with your own personal returns, now is the time. Like this week, get those done as quickly as possible. The last thing you want when the IRS is examining you as a preparer is for you to have your own tax problems. Now, if you owe the IRS and you're in an installment agreement or something like that, that's fine. You're okay. But you just want to get that taken care of. And we can help you with that as well as the return preparer stuff. The other big focus that I think will interest a lot of you, and not in a good way, is we've noticed this tax season, they've been asking a whole lot more questions about the relationship between the preparer and the ERO, or the owner of the tax business, or the EFIN holder. And they're really digging deeper into that. Used to be maybe once a tax season, I would have a situation where the IRS determined, hey, we're not going to hit, even though this return preparer, the person actually sat down with the customer and fed the info into the software. They failed their due diligence, but we don't think the owner of the operation did enough to train them or really armed them with what they needed to successfully know, understand, be trained in the due diligence rules. So we're going to hit the owner with a penalty. I would maybe get one case like that a year tops. I'm getting the feel there's just a lot more questions in these interviews, and it mainly where I see it is when I'm representing the actual preparer, not the owner. And so they're just talking to the preparer. I see them, they're asking a lot more probing questions about where the relationship is with the owner, what the owner has done to train them, what ongoing training there is. Are there any manuals that you can reference during the tax prep season and while you're sitting down with a client? Just they're going a lot deeper in there. And my big fear is they're going to hit both, which they can do. They don't have to pick one or the other. They could hit the same penalty on you as the owner and one of your preparers individually. I've never seen them do that yet, but I just have this sinking suspicion you might see something like that. But so fast forwarding, we get through the interview. Yeah.
Real quick, are there ever times that they forego sending the letter and they just come knock on your door unannounced, just pop in and, hi?
Absolutely. And those are called knock and talks. Typically what they do, they save knock and talks for really, it's almost like their outreach. They're trying to come out, kind of scare you, jolt you a little bit, maybe inform you, hey, we're seeing some stuff with your returns that are coming out of your office. You need to clean it up because we're keeping an eye on you. But every now and then we will also see a knock and talk that's how they're initiating this due diligence examination. So the most typical way that we see is what I described. They call you, or they send you a letter. They're always going to send a letter, but they may follow up the letter with a call and schedule a time and do everything that way. The other way, Jeremy, the second way is what you mentioned, a knock and talk, where they just kind of unannounced pop in and show up. And they like to do that typically during tax season. Have much of that now, but during tax season. And then a third thing that we've just seen pop up, it's a brand new program, is handling these audits by correspondence. And I've got, one client right now with one, he's in Florida and the examiner's in Nevada. Okay, so you can't get too much further apart than that. And before now, we've never really seen much of that. It's always been boots on the ground, where you are, where your office is. That's where the examiner's going to come. And whenever we see that always, as a former IRS attorney, I know exactly what that means. When they're starting a program to begin examining via correspondence audits, that means they're about to ramp up a whole lot more audits in this area, because an examiner for the IRS can examine a whole lot more cases if they're just sitting at their desk doing stuff over the phone and through the mail. They're not having to get up, drive across town, go meet you, sit in your office, all that dead, wasted time. So that tells me very plainly they are trying to streamline their processes so they can audit as many tax return preparers and tax return prep offices as possible with their limited resources. So those are kind of the three types of audits with respect to due diligence examinations that we see.
So I know that we've had previous conversations about how terribly written some of the regulations are around this, and the term surrounding reasonable, questioning, but they don't actually, say in this scenario, do the following. But if you could provide us some sort of insight into, let's just take head of household, for example, what sort of questions does the preparer need to be asking in order to cover their behind? Like, obviously, there's so many scenarios to consider. If we just looked at head of household, Schedule C income questions, and non-standard dependent, you're taking care of your nephew. Let's take them one at a time. Head of household, what kind of questions do they need to be documenting, and what's the most important part of that documentation? How would you do that, or advise them to do that?
Sure. Well, the most important part of documentation is actually doing it. I mean, just writing down, not only taking notes from your interaction with a customer, but really writing down your questions and writing down their answers. As kind of obnoxious as that sounds, I hear the IRS always tell me, "Oh, you got some good notes in the file, but I don't see any questions. I don't see any answers." Well, obviously, you can kind of glean what kind of questions you were asking, what the answers I gave from your notes. But that's, technically how the rules are written. They want to see a real Q&A format. They want to see, I asked them this question, this was their response. So as a result of that, I asked them this question, and here was their response. They want to kind of see that tennis match play out. So with respect to head of household, it's all the things that qualify you as a head of household. It's your software, fortunately, does a pretty good job of all that. But where it's going to kind of break down, and where I think, because I mean, head of household is fairly mechanical. Okay, it's a filing status. There's not a lot of sexy going on there. But what I think is going to happen is what I've really seen as a result of due diligence spreading out, not just to EITC, but child tax credit and the education credit, is now the IRS is really looking at the return as a whole, and it's telling them a story. Okay, so that's why little things like not being accurate on representing W-2 income, having an unrealistic Schedule C. What do I mean by that? Well, if you've got somebody that earns $35,000 a year on a W-2 income, and then you show on a Schedule C that they lost $20,000. All right, well, that just doesn't make sense. Nobody that makes $35,000 a year can afford to spend $20,000 or dump $20,000 into a failing business. Okay, now does that mean that scenario can't ever happen? Of course not. But that's going to instantly draw a lot of IRS attention, and that's going to be, that's going to be something they're going to penalize 100 out of 100 times, and we're going to have to fight that in appeals. So with head of household, it's the same criteria. It's what they're looking at to be head of household. Okay, is there a household? Are you taking care of dependents? It's the same type of analysis as we're looking at for EITC. Are these really your dependents? How can we show it? Well, if you're Samantha Jones and the child is, John Jones, okay, well, that's pretty good. At least our names match up. That's not as hard of a sell. But if those names are different, well, who is this kid? Is he your son? Is he your nephew? And then we have to ask questions around that. Now, I always say questions are great. Question and answers are great, but I'd rather have documents. Sorry, Jeremy, go ahead.
No, you're absolutely sorry. So if you're in a divorce situation, would you ask them, do you have a divorce decree, or do you have custodial rights, or what's the split between you and the other parent? Where is the other parent? Do you pay 50% of the household expenses? Are you receiving assistance for you made $15,000? How are you paying your rent, right? Are you receiving subsidies of some kind, or are you on some sort of program? Gosh, that would get uncomfortable.
Right.
But
no, you've got to dig
deep.
You got to dig deep. That's what you got to do, because they have to meet those criteria, and if they get audited, they're going to be asked the same questions, but in a not friendly forum. So this is your chance to ask those same questions, and that's how you can explain. That's what I always tell my clients when they push back on me. Let's say, well, gee, you're asking me to ask some really tough questions of my clients. I say, I understand that, but guess what? It's either you're going to ask it or the IRS. The IRS is probably going to ask it anyway. So you just have to explain to them, look, I'm not just protecting me, I'm protecting you. Because if we put this return out there, we file this return claiming all these refundable credits with your circumstances, you're going to get audited, and so am I. So we better do our due diligence on the front end so that we can pass the audit. You get your refund and refundable credit that you're entitled to. I pass muster on my side. Of course, I'm not going to care about your audit. That's your problem. But, then everybody wins. So this is really, we're doing this for your own good, Mr. Taxpayer.
So if you ask them a question, can you supply X documentation if asked, if they don't have it present, or what documentation can you provide apart from the 1095A where you and this individual is listed, and they don't have it present? Could you basically notate don't have it present but could supply it based upon inquiry, or if requested? Would that kind of cover you, or do you need to have them, all right, go home, come back with the doc before we can proceed?
Right. Well, that's the $1 million question. Depends on the appeals officer. I of course argue that, because I always end up with a bunch of files that say that. I asked them, can you provide this documentation on audit, and they said yes. So here we go. That's not the same. That technically doesn't meet the record keeping requirement, because you're basically memorializing the fact that you have no records. So it's almost on its face in violation of the rule, the due diligence rules. It's better than nothing. And where I find I can leverage it more is on the Schedule C side. Now, to your point, they're going to be focusing more on Schedule C, so we'll see if that changes. But to me, the return preparer has the hardest job with respect to Schedule Cs. Kids are a little easier, dependents. we should be able to, this person who's taking care of them, and if they're living with them the majority of the time of the year, and they're providing more of their support, they should be able to provide a school record, a doctor's record, something that has kid's name and our customer's address on it. Even a lease that lists them as a full-time occupant. I mean, that shouldn't be that hard to come up with. Schedule C is a lot harder to come up. If they come in and swear up and down, hey, I make $20,000 a year and I have $16,000 of expenses in these categories. I don't have a bank account. I don't keep QuickBooks. I deal in cash. Well, I mean, my gosh, what else can you get? There's really nothing else. There's no documents to have other than what they may sit down and produce in your office on a form that you hand them, asking them to detail what their income and expenses are. And as a result of that, we're much better able to push those things through in IRS appeals when we challenge these penalties on the Schedule C side than we are on the qualifying children side.
Wonderful. All right. That was an intentionally depressed voice. We've got a number of questions, and I think it's going to be great. So, will having the taxpayers sign an affidavit, of the Q&A during basically sign your questionnaire at the end of it, help at all?
Yeah, absolutely it will. That all definitely helps. I mean, my pecking order is I want documents. Nothing beats documents. If you've got grandma taking care of grandkids and she's got a Schedule C showing a loss, hey, that's okay. If I've got a shot record or a lease showing the kid lives with grandma, okay, I'm fine there. And we've got a Schedule C showing a loss on it, but she's provided us some invoices that verify her expenses and maybe bank statements that show she only, deposited $18,000, so that verifies that. Then hey, great, we're golden. You're never going to have that, or very rarely going to have that. But the next step will be, okay, Q&As. If we don't have documents, why don't we have documents? What do we have, and what is their testimony, so to speak? What is their story? So why are you taking care of the grandkid? Where are the parents? What happened to them? Which one are you the grandparent of, or which one are you the parent of, the mom or the dad? Where is everybody? Are you getting any assistance from anywhere to provide for this child? Tell me about your business. Why did your business suffer a loss? Has it ever had income? Do you anticipate it's going to have income in the future? What are you doing to make it more profitable or reduce expenses or bring up income? The more questions and answers we can have, the better. I'll always take documents. Documents trump everything, so IRS really can't say anything. But in lieu of documents, definitely we'll take questions and answers. And part of that is if they'll fill out an affidavit saying, I swear up and down that I'm taking care of them, again, I would say, well, surely there's some document out there that you can get on the child side, but it's sure better than nothing. If we have them sign intake sheets and things like that, it's definitely better than nothing.
Nice. Written documentation versus typed documentation. Is there a difference, or do they both pass?
Assuming we're talking about notes like Q&A.
Correct. And so I write up a sheet. I'm asking them the questions. I'm documenting their responses. If it's typed, does it matter, or written, preferable, or what?
Whatever you're better at. Personally, I'm a much faster typer than a writer. So if I was one of you guys, I would be typing it in my software. I'd be putting all those notes in there. I'd try to keep it all as contained too as I could. But, I get a lot of people that have, I've got one preparer that literally keeps her handwritten notes on the inside of the manila folder. And they're great. She does great jobs. She does great Q&A in there. And, it was fine. It was a little obnoxious and cumbersome for us to make sure the IRS saw that and for us to copy that, scan it so that I could see it. But, that worked great. So handwritten versus typed into a computer or typed onto a Word document and printed out, that doesn't matter at all. It's the substance of it, not the form.
Very good. So I've seen this question in in the list here a couple of times, and I'm sure you've seen it as well. Household employees versus Schedule C. Which ones, does the household income throw a flag as opposed to a Schedule C? Which one's more audited? Just kind of throw that out there. They're talking about household income.
Right. The IRS hates household income, and it's a horribly cumbersome, the whole Schedule H and all that stuff. It's both the household employee as well as the person paying them. It's a bigger audit red flag for both. I feel more comfortable throwing it on a Schedule C, especially since if we're calling it income, it's going to be a positive Schedule C, and they'll have very little expenses. If we're talking about like a maid or a nanny or something like that, they're going to have minimal. They're going to have very minimal expenses, but that's okay. I mean, that's what we would expect to see. So,
and household employees not subject to self-employment tax, which makes the refund higher, which is why I think people do it.
Yeah, there's no question about it. And obviously, what the IRS is going to be looking for. I mean, if you really have that situation, then you really have the situation. It's okay. My big thing isn't don't worry too much about what's going to get you audited. It's what's going to be the result of the audit. Let's focus on that. Because at the end of the day, you can't control if the IRS is going to come look at your file, whether you're a taxpayer or tax return preparer. If you're off as a tax return preparer, and this is what I tell my clients all the time. That's why I focus so much on trying to educate my clients. There's nothing we can do about your customer base unless you scoop up and move to, the glistening side of town, your office, where all you're going to be dealing with is people that make six figures and are, professionals and business owners and things like that. Well, if you're doing refundable credits, basically working poor's tax returns, you're going to get audited as a return preparer. You've got to get cozy with that fact. So don't worry so much about what's going to get you audited. Worry more about what can I do to have a successful audit, to navigate through the audit successfully. I mean, that's really where we need to put our focus. So at the end of the day, if somebody comes in, they're really an aunt. It's really household income. Okay, then you can report it as such. If it's really more, if they're a maid, but they're a maid for a bunch of different people, well, they're really not a household employee at that point. They run their own maid service, and they clean 50 people's houses or 20 people's houses. That's more in the nature of Schedule C, and that's where it belongs. And they would have more expenses. They buy cleaners and brooms and mops and stuff like that, and they have mileage because they're driving around to different locations. So, it's not, don't worry so much about what's going to get you audited. Worry about what's going to survive on audit.
So in your opinion, I mean, you're building a case, just to kind of reference back to what you said earlier, as far as an auditor comes into the office and you've had it happen exactly 0 times that they shake your hand, say, pleasure meeting you, and they leave without having some sort of findings. I've even heard of clients tell me that the field agent came back multiple days later and said, my supervisor said, I've got to find something. I need to look again. And
3 times last year. 3 times last year.
Right. So being that that's the case, if they're coming in, they want your money, they're going to fine you. Being that that's the case,
right.
The real objective in doing the due diligence is to provide you ammunition in order to, properly or adequately make a case as to why the field agent is stupid.
Exactly.
I mean,
why they're
cutting
wrong and asserting the penalty.
I like my term better.
Yeah, maybe.
Why they're just being a jerk. So in your say that again, I'm sorry.
I said, well, you never know who's listening, so I'll try to take the high road on that. But yes, I find it very hard to disagree with your characterization.
Yeah, I'm not going to say my full name on this call for that reason. What was I just going to ask you? It was brilliant. Never mind. We'll move on because I can't remember. It'll come back to me. We've got a number of questions kind of pouring in here. So Dad has a divorce decree. Oop, it just moved because there's another one. He claims the kids. Mom comes in and files taxes wanting to claim the kids. Kids actually is in the home with the mom, primary. What he is supposed to do. So Dad's more or less, legally supposed to be taking care of them, but Mom's actually doing all the work. What do we do in that sort of scenario?
I've run into that. Yeah, I've run into that exact scenario, and how I've run into is a little different. I've run into a return preparer who actually was doing a great job of really populating their files. A lot of good documentation in there, but what they were falling victim to is not really reading all the documentation they had in the file. So, in that one of her files, we had a divorce decree. Well, the mom was taking care of the child and claiming the child as a dependent, but the divorce decree very plainly stated 80% custody went to the father. So it was kind of like, okay, this is like not helping it. This is like counter, and this is arguing against our story on the return. But I understand that those situations happen. Just because a court awards one parent custody doesn't mean that's how it's going to play out. That parent may lose his job or her job, or who knows, all kinds of things may happen such that the child ends up at the other parent's house. Well, that's who gets credit, who gets the dependent exemption, gets to claim the dependent, is the person taking care of them. Where do they live more than 50% of the year, and who's providing more than 50% of the support? I don't care what the divorce decree says. If that's the reality, that's how the law works. Now, you got to be able to prove it. That's the problem. And obviously, the divorce decree won't help you if we're going against the divorce decree, and dad may be taking care of the kid, or I think in the question that was posed, mom is really taking care of the kid, even though the dad wins in the court decree. We just need to be able to support that. If we can show, the more we can show that establishes, again, child's name and parent's address, whether it's a lease document, school record, any mail that the kids get. I know kids don't get a whole lot of mail, but anything they get that has their name on it and your address, or the claiming parent's address, that's what we're going to have to bolster that file up with. So yeah, don't be scared off by the divorce decree, but we have to follow when determining who gets to claim the dependent, it's the reality, not just what some court issued. And just to put it, very strongly, the IRS doesn't give a rip about local or state level courts. They're federal. There's a thing in the United States Constitution called the U.S. Supremacy Clause. The federal government trumps local. So we run into tax issues all the time where you have state level judges in divorces trying to dictate, you have to pay these taxes and you have to pay these taxes. The IRS just sits back and laughs, and they rip right through divorce decrees. I don't care what the decree says. If, according to federal law, both parties owe the tax, then both of them owe the tax. Doesn't matter what some divorce judge says. Same thing here. We don't care what a divorce decree says. If the reality is one parent is taking care of and housing the parent or the child more than 50% of the time, they get to take that dependent, not the other child, and not the other parent.
Question for you. Are they, well, first of all, how far can they go back and audit you for tax returns, due diligence? And then are they primarily focused on current year or prior year, or is it just dependent on the individual circumstance?
Well, no, these are pretty orchestrated undertakings by the IRS. And what I mean by that is, last year, for example, many of you, I'm sure, about to nod your head, they came in at the worst possible time. They were coming in late January through February and into early March, right in the middle of your crazy tax season. That's when they wanted to do due diligence audits. And if it was early enough, usually they were audits of the 2016 tax return.
So the previous year.
Correct. Now, some that happened later in the tax season were real time, were actual, real audits. We had a couple of those. But for the most part, it was the previous year. This year, they came out earlier. It took us a little bit by surprise. They came out in October and November, and they're still coming in December. So I'm in the throes of, IRS IRS due diligence interviews. I had 2 on Monday. I had 1 on Friday. I think I had 1 yesterday. I can't even remember at this point. But yeah, we're kind of wall to wall with them now, and they're all reviewing 2017, so last year's returns. So that's typically how it is. And with the PATH Act, if there's any ray of light that came with the PATH Act, which expanded the due diligence rules from the EITC to all 3 refundable credits and now head of household, is it's reduced the number of years and just in general number of files they're going to look at. Currently under their own self-administrative rules, they're only going to look at 1 year's returns and only 50 of those returns, because there's simply too much work now. They're looking at each file for 3, and then this coming next year 4 issues to determine whether you met your due diligence responsibilities. They can't pick more than that. I mean, back in the old days, 5 years ago, I mean, the worst I've ever seen was they did so many files and asserted so many due diligence violations on one guy. I didn't represent him in the audit. He came to me, much later. But he got racked up with $850,000 of due diligence penalties, and that was hundreds of returns per year. Yeah, hundreds of returns per year with 3 years in a row, and it just added up to this mountain. We don't see anything like that anymore. They're limiting it to 1 year and 50 returns.
What would you get it down to?
He was an interesting case.
Just lie to us to make us feel good. Just lie to us.
Well, I'd love to make it. He fled the country is the reality. So, I have plenty of. Yeah, he literally stopped returning our calls. I think he was from another place originally, and I am pretty sure he went back to that place.
Marshal Service is after him, but that actually brings up a terrible segue, but I'm going to use it anyway. If an auditor was to call you and say, hey, Garrett, I want to come into your office on X date, or send you a letter, and you're just not having it, right? You're in the middle of tax season, February 5th. Can you ask for a postpone? Can you ignore that for a period? And if you do and don't respond, what is the potential recourse versus what's the probable? What's the time? I mean, what are your rights? Because you're trying to run a business and you're being, you're trying to jam me up intentionally. What rights do you have as the owner during the process?
No, not a ton. I mean, the tax code gives the IRS incredibly broad powers to conduct an audit, no matter what kind of audit it is. Having said that, we found most agents are pretty workable, and they understand a little bit at least that, tax season and how much that means to you guys, and different than CPA offices that kind of have this longer tax season starting in January and extending all the way through April, and then they have, a good chunk of their clients file extensions and go on. You guys are different. I mean, it's all truncated into this 6-8 week period, and that's really it. So we've had pretty good luck in working with the agent saying, look, we just can't do it this week. It's going to have to be a couple of weeks down the road, 4 weeks down the road. We've been able to extend pretty well. Now, some agents aren't that way, and they'll say, well, I'll give you 1 week. After that, I'm going to call you a no-show. And if they determine it's a no-show, they're going to go through all 50 files that were coming out to examine and hit you with the due diligence penalty on each refundable credit or coming next year head of household status contained in those files. They're going to hit you with the max penalty, say, have a nice day, and leave it up to you to go fight it.